Hi, I'm Nikki Amore, certified financial planner and certified private wealth advisor at Falcon Wealth Planning. I want to talk to you about the purpose of credit. Did you know that you have a barcode? Your social security number is the only way that the government has to identify you, but your credit score is the only way banks know how to rate you. Your credit score is the only way to rate you to assess your responsibility. If you open a new credit card and you immediately max it out, your credit score will be negatively impacted. We want to talk about credit because it's one way that you can leverage debt to build wealth so that you can borrow money from someone else in order to grow your net worth. That's why it's so important to have a good credit score. You can get preferred status when you have a good score, just the same way you can get into a college that you want to go to if you've got great grades. Now, if you're in college, you're likely new to credit. You can get a credit card, but it's usually got a 30% interest rate. So you're going to want to pay it off fast. And when I say fast, I mean if you swipe your card for coffee in the morning, you're paying for your credit card as you're walking out the door of the coffee shop. That fast. If you can't get a credit card, you do have an option of what's known as a secured credit card. And when you secure it, you put money down. This type of card gives you the opportunity to prove that you're responsible. Now, who gets to say if you're responsible? It used to be dependent on where you lived, but now there are three major credit bureaus: Experian, TransUnion, and Equifax. Now, why do these three matter? Because how they rate you determines how much leverage banks will extend to you. They rate how long you've been building your credit, whether or not you pay on time, how often you've applied for new accounts, whether or not you have different types of accounts, and how much you owe compared to how much you're allowed to leverage or borrow. Now, when we talk about leverage, it's using or borrowing someone else's money so that you can grow your net worth. Let's talk about the different types of leverage. Most of you are probably familiar with a mortgage, and a mortgage allows you to buy a home before you have the entire value of the property. If you want to buy a home valued at $700,000, do you want to wait until you have 700,000 or $140,000? If you have a great credit score, you can buy the same house with a down payment of just $21,000. Or if you're a veteran, you may not even need to put any money down to start. This type of leverage or borrowing historically has the lowest rates compared to any other types of loans. And when you're buying a home or a car loan, you have 30 days to shop for your favorite rate and pull your score multiple times. And it just counts as one credit check. So, as you think about the interest that you have on your mortgage, did I mention that you can use it as a write off for your taxes? Now, car loans typically have lower fixed rates than credit cards, but there is a time frame where you will pay 100% of the full amount of the loan. Depending on your situation, they can also be a tax write off. And sometimes, depending on how responsible your credit score says that you are, you may even qualify for a 0% interest rate. Do you see why it's important to understand credit yet? Now, revolving lines of credit can be open forever, like a HELOC or a home equity line of credit or a pledged asset line. These lines of credit are lower rates than credit cards, but they change. They often have security in the form of collateral. Remember the secured credit card where you put money down to prove that you're responsible? A HELOC or a home equity line of credit is secured by your home. A line of credit or pledged asset line may be secured by your investments. These types of borrowing can also be a write off as well. Now, we've talked about mortgages and we've talked about car loans and lines of credit and how they have lower interest rates than credit cards. But I want you to know I love credit cards. I love them. You can use someone else's money for 30 days and they offer fraud protection. So you're not held responsible for someone else using your card. And they give you rewards like free miles. Don't you want to go on a free vacation just because you use someone else's money? Yeah. The problem with credit cards is that if you don't pay them off as soon as you get the bill, interest will start accumulating. And while many department stores offer credit cards, they tend to carry higher interest rates. And these cards may make sense for a one time purchase if you're offered 12 to 36 months of 0% interest. Remember, using someone else's money to grow your wealth. So, how do you get a good score? Pay your bills on time and keep how much you owe at all times less than 10% of what you're allowed to borrow. Keep the card that you've held the longest. 25 years is the maximum that will benefit you, and have different types of leverage: a mortgage, a car loan, and one no annual fee credit card with your favorite rewards program. Remember, pay off those cards before or when you get the bill, or as soon as you're walking out of the store where you made your purchase. If you don't have the money in the bank, don't put it on a card. In the past, when you've carried a balance on your credit card, it made a positive influence to your credit score. Now, paying off all your cards will benefit your score the most. If you're looking to borrow for a home or a car, it's important not to apply for new accounts. If you can, go 2 years between these big ticket purchases like a home or a car purchase. This time will allow your score to bounce back for when you need to use it again. If you have questions, let us know in the comments below. If you enjoyed this video, don't forget to like and subscribe. We look forward to serving you. Thanks for your time.